I'm Annisa Noor Firdausy, accounting student of Universitas Islam Sultan Agung Semarang. Today we will learn about account receivable or AR. Let's check it out. Let's start with account receivable or AR. First, what is account receivable? Account receivable or AR is the balance of money due to a firm for goods or service delivered or used but not yet paid for by customers. Account receivables are listed on the balance sheet as a current asset. AR is any amount of money owed by customers for purchases made on credit. The second we will learn is types of receivables. First is account receivable. Second is notes receivable. The third is other receivables or non-trade receivables. First is account receivable. Account receivable are balance customers owe on account as a result of the sale of goods or services. They are usually short-term, unsecured, non-interest bearing, and represent the most significant receivables held by a company. Because they arise from business or trade transactions, they are also referred to as trade receivables. For example, if goods were sold on account, sales would increase in a credit and receivables would increase a debit. This is journal entry for sale of goods. Date January 31, 2018. Description: account receivable on debit and sales on credit. This is journal entry to record sale of goods. When the customer pays cash for the amount of they owe, the company's cash is debited, which increase the cash balance. Receivable are credited, which reduce the receivable balance. This is journal entry for customer payment. Date March 1, 2018. Description: cash on debit and account receivable on credit. This is to record payment on account. The second is note payable. Notes payable represent written promises typically evidenced by a formal instrument to receive a specific amount of money, plus or with interest, at a designated future date or on demand. The promissory note is a written promise to pay a specific amount of money at some definitive date or on demand. The borrower or customer promises to pay to the lender or company a definite sum of money, plus or including interest, at a future date, which is known as the maturity date, or the date on which the marker or debitor must pay the note's balance to the payee or creditor. Notes receivable may or may not arise from business or trade transactions, and they are usually issued for long-term period. They may be classified as either short-term or long-term. Notes receivable may also be secured, meaning the borrower or customer provides the lender or company a claim to a certain amount of its assets, often referred as collateral, in the event of the borrower default or failure to pay the note. The third is other receivable or non-trade receivables. Other receivables are claims held from a variety transaction. Okay, let's go to recognition of account receivables. If we are operating under accrual basis, we record transaction irrespective for any change in cash. This is the system under which we record an account receivable. In addition, there is a risk that the customer will not pay us. If so, we can either charge these losses to expense when they occur, known as the direct write-off method, or we can anticipate the amount of such losses and charge an estimated amount to expense, known as the allowance method. Valuation. Receivables of all types are normally reported on the balance sheets at their net realizable value, which is the amount of the company expects to receive in cash. Business owners know that some customers who receive credit will never pay their account balance. These uncollectible accounts are called bad debts. Companies use two methods to accrue for bad debts: the direct write-off method and the allowance method. First is direct write-off method. For that purpose, companies must use the direct write-off method, under which bad debts are recognized only after the company is certain the debt will not be paid. Before determining that an account balance is not collectible, a company generally makes several attempts to collect the debt from customers. Recognizing the bad debts requires a journal entry that increases a bad debts expense account and decreases account receivable. If customer named Jasmine fails to pay a $100 balance, for example, the company records the write-off by debiting bad debts expense and crediting accounts receivable from Jasmine. This is the journal. The second is allowance method. Under the allowance method, an adjustment is made at the end of each accounting period to estimate bad debts based on the business activity from the accounting period. Established companies rely on past industry efforts until they have sufficient experience to make their own estimates. The adjusting entry to estimate the expected value of bad debts doesn't reduce accounts receivable directly. Account receivable is a control account that must have the same balance as the combined balance of every individual account in the accounts receivable subsidiary ledger. Since the specific customer accounts that will become uncollectible are not yet known when the adjusting entry is made, a contra asset account named allowance for bad debts, which is sometimes called allowance for doubtful accounts, is subtracted from accounts receivable to show the net realizable value of account receivable on the balance sheets. This is the journal. The first journal is bad debts expense in debit and allowance for doubtful accounts in credit. This is for recording estimated uncollectibles. The second journal is allowance for doubtful account in debit and accounts receivable Jasmine in credit. This is for recording write-off Jasmine account. After we learn about account receivable, let's do the text. Flower Ltd. profit sold merchandise to Butterfly Ltd. on January 14, 2013 at price of $20 million and the payment terms are 2 per 10 and 30. On January 16, 2013, a sales return was received from Butterfly Ltd. due to the poor quality of the goods at a price of $1 million. On the 21st, the receivable from Butterfly Ltd. were received in full. make a record of account receivable for the above transaction. So let's answer it. The list for January 14, the first is account receivable in debit 20 million US dollars and sales in credit 20 million US dollars. This is to record receivable due to credit sales. The second is listing for January 16. Sales returns on debit 1 million US dollars and account receivable on credit 1 million US dollars. This is to record sales returns. The third is listing for January 24. Cash in debit 80,620,000. Sales discount on debit 380,000 and account receivable in credit 19 million. This is to record receivables settlement. Sales discount is from 2% times 19 million. The following is an example of presenting accounts receivable on a balance sheet. Current assets is the first is account receivable 20 million, allowance for bad debts minus a million, and then we can find net realizable value is 19 million. Thank you very much. Okay, that's all for account receivable. If you have any questions, please comment below. Thank you. Bye.